we're going to do some examples of liabilities that are created from advanced collections. Each one of these, there's some similarities between them, but there's specific situations that firms deal with on a regular basis. But we're going to see how the accounting is done for each one of them. The first example is something called a refundable deposit. With a refundable deposit, basically, a customer is giving money to the company that when the customer comes and does something in the future, they're going to get their money back. So when I was in Iowa and I was teaching this, the example I always used was the recycling bins. It doesn't work here because for whatever reason there's no deposits associated with this, and you don't get your money back when you give them back to waste management or whoever it was. So everyone here in the past couple of years, the example that they always give is of beer kegs. Okay, so if you go and you rent a beer keg, basically, you take the beer keg home, you use the beer for whatever you're using it for, and then you return the keg back to the person you rented it from. And to be able to do that, you have to give them a deposit for the keg so that you'll return it. Can someone give me another example of something that we do this with?
Tools at AutoZone.
Okay, tools at AutoZone, that's a good example. I think Home Depot also rents tools, and I think gives you a deposit for those as well. I like that idea.
Apartments?
What's that?
Apartments?
Apartments sort of works, not completely. All right, so however you want to think about it, beer keg, tools, whatever, that's what's happening here. And the first key thing to understand is the money that the company is receiving is not revenue, because they're giving it back. It's a liability when they receive it. And so that's the liability part that we're dealing with. So here's our example. Corinne's Chemical Company, Corinne is my 10-year-old. Corinne's Chemical Company received customer deposits on returnable containers in the amount of $200,000 in 2009. 12% of the containers were not returned. The deposits are based on the container markup of 10%. Record the necessary journal entries. So in other words, Corinne received deposits of $200,000. 88% of them, of the customers, came back and returned the containers and got their money back. 12% did not. And so we had to deal with both the ones, the original deposit, we're going to deal with when they get returned and when they don't get returned. Those are basically the three things that can happen. All right, for the first one, we're going to record the initial deposit that we get. We are going to get cash from all these customers of $200,000. And we're going to create a liability. And we'll just say these are deposits, so we know what they are, for $200,000. So that money we receive, not revenue, it's a liability when we get that cash, because we're going to have to give it back to them. For the ones that were returned, the 88%, so we'll do 200,000 times 88%. We'll assume that they get all of the money back, $176,000. We're going to have to pay out cash of $176,000, and we're going to get rid of the liability when that happens. Liability. That's that. Anyways, liability for $176,000. All right, and then the final thing we have to deal with, and we're going to assume that there's an expiration. After a certain date, they can't return them anymore. So what do we do with the rest of the cash that we received? They never return these containers. What do? We basically pretend like we sold it to them. So you're exactly right. We are going to, the other 12%, we sold it. That's essentially what we're going to do. We're going to get rid of the liability. Deposits, which is the other, $24,000. I apologize, I don't have quite enough room here. There needs to be 3 more things below this. We are going to record revenue for the same amount. Basically, we're saying we sold these to these people because they didn't return them to us. So, if, for example, you don't return your beer keg, what are they going to do? They're going to keep the money and say, hey, we just sold this beer keg to you for this amount. So they're going to keep a deposit greater than the value of the thing, or equal to the value of the thing that they are giving you. If you do deposits on cards, you use your credit card, and I'm sure they couldn't take out the amount of the vehicle. Anyways, I was just thinking about deposits. All right, and at the same time, whatever it is these containers are that they borrowed from us, we're not getting them back. And so for these other ones, we never took these containers off of our books. If they're inventory or whatever they are included in our assets, even though all these customers are holding them, they're still ours. And so we never took them off of our books. But now we're never getting these ones back. And so now we need to take them off of our books. And it says that they have a 10% markup. And so we're going to assume that this $24,000 is a markup of 10%. And you need to be careful with this, because if you take 90% of 24,000, you just got the wrong number. Because it's a markup from the original number up to 24,000 is a 10% markup. So the way you really need to do this is take the 24,000 and divide it by 1.1, and that'll give you 21,818. Or in other words, the X multiplied by 1.1 equals $24,000. Those two are the same things. And the X equals the 21,818, which is, if we then mark that up 10%, you get the $24,000. So then we will record a cost of goods sold of 21,818, and we're going to reduce our inventory by 21,818. Does that make sense? Any questions about that? So those are refundable deposits. So it gives you cash that you're later going to give back to them if they perform something, give you something back or do something. Our next example, example number 4, are advances from customers. This is not a refundable type of thing. This is, they are going to give me money for something I'm going to do in the future. So the example I always use for this is, what's the name of that store? Shoot, there's a furniture store that's very expensive. Tell me some expensive furniture stores, relatively expensive.
Thomasville.
Not Haverty's, not Thomasville.
Ethan Allen?
Ethan Allen, who said that? That's it. Ethan Allen is the one I was thinking of. Okay. So a couple years ago, my wife wanted a new couch, so we went to Ethan Allen to see what they had. Well, Ethan Allen, you do not go in and walk through the store and find a couch and buy that couch, because you cannot buy anything that's in the store. The way that they do it is they show you some examples, and then they say, okay, you want this type of couch. Now, what type of covering do you want on it? What kind of padding do you want? What kind of feet do you want? What color stain do you want on the feet of these? Do you want those little peg things, or whatever those things are? And they get that specific, and then they get the details, and then they charge you a whole ton of money, and then you wait a month or two, and then that couch that you envisioned shows up at your house. That's the way it works with all their furniture. Has anyone ever bought anything from there out of curiosity? Okay, we have not either. Because it was way too expensive. This couch that we wanted, I think they wanted like $6,000 for it. And I'm like, no. They go like by 3 somewhere else. So we didn't buy it from them. Anyways, so that's the way it works. But you have to pay that money up front as soon as you order it. You wait 2 months, and then your couch shows up. And so they're getting a bunch of cash, and they haven't done any work yet. And that's what's going on with this example. So, in our example here, we have Double Rainbow Company. They receive refundable advance payments with special orders for containers constructed to customer specifications. Related information for 2009 is as follows. And so, at the end of 2008, they had advances of 210. In other words, this is money that they have received, but they have not yet shipped to someone. Advances received with 2009 orders. This is people that went in and said, this is what they want, this is what they want, gave them their money, and then they're waiting for the thing that they're getting. Advances applicable to orders shipped. This is the things that finally get shipped during this period. Advances from orders canceled in 2009, which seems very large, it's just a random number. And we'll deal with what happens when they get canceled. And in this example, it's refundable, but we'll also talk about what if it's not refundable or what if it's partially refundable. We'll go through all three of those examples. And then we're going to record the necessary journal entries. So our first journal entry is going to be recording these advances that they received in 2009. So basically, they're going to be receiving cash, and very similar to what we did up here, we're going to record a liability. But we're going to call this a liability, 295, an unearned revenue this time. Because once we fulfill the order, it will become revenue. Not all firms use the word unearned revenue. Sometimes they call them advances. Sometimes they call them deposits. So just be aware, but the most generic version of this is unearned revenue. All right, so that's 295, and we're going to keep track in a T account the amount in this account. So we started with 210, we just added 295 to it. The second journal entry is going to be when we actually ship some goods. So we deliver the couch, we deliver the container, whatever this problem is asking us for. And when that happens, this liability goes away, the unearned revenue. And that's for 280. At the same time, we're going to record sales revenue of 280. And incidentally, at the same time, there would be cost of goods sold and inventory, but we're going to ignore that because it's not important for this particular problem. But just be aware that will also be happening at the same time. So when we do that, this unearned revenue just got reduced by 280. Okay, so we have the receipt of cash, and then we have the delivery of goods during the period. And the last thing we have to deal with are these canceled orders. So this is a relatively large number, but don't worry too much about how big it is. So if it's refundable, probably before some certain date that they went too far, then they're going to give them back their cash. So we're going to credit cash for 145, and we're going to get rid of the liability, because once we have given the cash back, we don't have to do anything more, so we're going to debit the unearned revenue of 145. Is that clear to everybody? What's going on with those? All right. So what happens if it's non-refundable? Is it going to be this journal entry? No, because we're not giving them back cash. They decide, no, I don't want it anymore, and you say, well, fine. And you basically record the same thing as if you delivered it. Because you have fulfilled everything you're supposed to do. I mean, even if you just take the thing that you made for them and then throw it into the dumpster for them, they don't want it anymore, you've fulfilled your part of the bargain. And you just recorded that you delivered it, basically, even if it went to the dumpster. Or if you didn't even start making it, you still record that you delivered it, because you did your work. What if it's partially refundable? What if you can get half of the money back? It would basically be half this entry, half this entry. You debit the unearned revenue for 145, and the amount of cash you're giving back you credit, and the rest would just be sales revenue. So half of it would go to cash, and half would go to sales revenue. You give back half the cash, and the rest would just be sales revenue to you. So those are all the possibilities. And obviously, if it's some other percentage, then you just multiply it by that percentage.
So you said if it's not refundable, it would be like
It would,
the second entry there.
yeah, it would be the exact same, except for with 145 in place of the number. It's there. So do you see that none of these are hard? There's just lots of them. Have we seen this? I mean, are any of these by themselves hard? No, none of them are. So keeping them straight and making sure you understand all of them is really the only key to this particular chapter. Example 5, collections for third parties. So for collections for third parties, for this one we're getting money we're paying back. For this one we're getting money we're not paying back, we just need to do something. For this one we're collecting money that we're giving to somebody else. Okay? The easiest example of when that happens is when you collect a sales tax. So when when a firm collects a sales tax, basically what they're doing is they're acting as a tax collector for the state or for the county or for the city. They're taking money from the consumer, and they're gonna hold that, and then they're gonna give it to the state or the county or the city. That money is not revenue to that company. All it is a liability when they get it, and then it goes away when they pay the cash to the correct governmental body. So, here's our example. For the September through December period, sales totaled $5 million. The state sales tax is 4%, and 75% of the sales are subject to sales tax. So why might some sales not be subject to sales tax? Or why might some things not be subject to sales tax? Any examples?
Services.
Services, there's no sales tax associated with services. If you're from a different state, many times food is not taxed. Here it's just taxed at a lower rate. But many states, there's no tax on food. Any other examples?
I think services is state by state too.
I'm
I'm pretty sure. I want to say.
Could be, I don't know. I've never
I
lived
work
in a
in the
state.
service industry, and I want to say there's one place we travel
It's possible.
that we have to pay taxes and we offer a service, and I can't think of.
Alright, so in most cases, services don't have sales tax associated with them. Sounds like maybe somewhere there is, I don't know. I guess the other possibility is that maybe there's some jurisdictions that don't have sales tax for some of our sales. Because I believe there's a couple states that don't have sales tax. Am I lying here?
Delaware.
Delaware doesn't have sales tax? They just have enormous property tax?
Is New York?
What's that?
New York has?
New York is.
New York does, yeah, for sure.
Sales tax.
What's that?
Which state,
Florida has sales tax.
which state have the,
Yeah, income tax.
Arizona,
What's that?
Tennessee.
Atlanta City?
Interstate
Which state
commerce.
is that?
Interstate commerce, yes.
Usually.
Which is
They're
sort of,
they're in the same state as you.
yeah, sort of. Amazon started charging sales tax, which is annoying. Alright, anyways, back to what we're doing. Alright, 75% are subject to sales tax and the tax rate is 4%. So we need to figure out how much we're collecting first of all. So we have 5 million, and we're gonna multiply by what percentage actually collects sales tax, and then the percentage that, of the sales tax. And so we're gonna be collecting from our customers $150,000. Very nice of us to do this for this governmental body. Very nice. We don't have a choice, but it's also very nice of us. And so when we sell these things, we're gonna receive cash of the 5 million plus the 150,000. So we're gonna receive cash of 5,150,000. And we're gonna record sales revenue of just the 5 million. And then we're gonna create a liability called sales tax payable for the 150,000. It's not our revenue, it's really the key idea here. It's a liability instead. So the 150 is a liability to us. And then eventually when we pay it, we're gonna pay out cash of $150,000, and we're going to debit the sales tax payable to show that we don't have that liability anymore of $150,000 when we pay it to the state, city, county, whatever it is that's collecting it. So incidentally, my understanding is that if you're one of the people that have to calculate all the sales taxes from the various jurisdictions for companies, it's a horrible job. Does anyone do that, has ever done that for their job? I hear it's horrible. Just because like every county has a different rate and you have to keep track of how much sales you have and you have to make sure you pay the correct amount to that county, and I hear it's just a big, huge, horrible mess. And so if you have a choice, don't get that job. It's my understanding. I've never done it myself. That's just my understanding. All right, one last example in this category. Gift cards. So gift cards are an example, another example of when we're receiving cash, but we haven't done the work yet. When is the work completed for gift cards? When they're redeemed, right? So you go into a store, you sell a gift card, you didn't do anything. All you did was you basically exchanged one currency for another, sort of. And then it's when they bring the gift card in to redeem it for the service or the good, that's the work that you're actually doing, and that's when you get to go ahead and record the revenue. The only other issue we have to deal with gift cards is what if they're never turned in? And we'll deal with that possibility in this problem. So during their December 2010 Christmas promotion, this company sold 20,000 gift cards at $25 each. All gift card sales were for cash. On December 31st, 2010, only 1,000 gift cards had been redeemed. Unused gift cards expire December 31st, 2011. So this is an outdated problem. Why is this an outdated problem? Gift cards are no longer legally allowed to expire in the United States. This has only been true for maybe a year or two, maybe 2 years, something like that. But the accounting for it is basically the same. Instead of having an expiration, you basically say, at this particular date, the probability of it ever being redeemed is so small that we're going to go ahead and assume it's never going to be redeemed. They lost it, they went through the laundry, I don't know, something happened, it's never going to be redeemed. And so you still come up with a date, you say, after this date, we're just going to assume they're not going to be redeemed. So you don't have to have an expiration, and the accounting still works the same way. But we're going to pretend like there's an expiration date because it makes it more obvious. So we're going to prepare the journal entry on December 31st to record the sales and the redemption of the gift card. So they sold 20,000 gift cards at $25 each. So we're going to take 20,000 and we're going to multiply that by 25, and that is going to give us $500,000. So we're going to receive cash of $500,000. And we're going to create a liability, and we're going to call this unearned revenue again, because it's eventually going to become revenue. But you could, if you wanted to, you could call this gift card liability or something to that effect, and that would be okay. I'm going to call it unearned revenue of $500,000. And then we have 1,000 that gets redeemed during the year. So let's go ahead and record that. And we're going to debit unearned revenue to show that it's now earned. $25,000 worth, 1,000 times 25, and we're going to record sales revenue, and at the same time, assuming it's a good that we're giving out, we're going to record cost of goods sold and inventory, but we don't know those numbers, so we'll ignore that for now. It doesn't, not that important for this particular problem. Everyone okay so far? Mm-hmm. Concerns? All right. December 31st, 2011, so 1 year later, 18,500 additional gift cards have been redeemed. Prepared the journal entry on December 31st to record the 2011 redemption. So we're going to take an additional 18,500, multiply that by 25, we get 462,500. And we're going to do the same journal entry again, unearned revenue for 462,500, sales revenue, because we've now done the work. 462,500. And then on that same date, 500 remaining cards have not been redeemed. They were lost, forgotten, they didn't get redeemed, and they expire. Or, alternatively, they didn't expire, but at this date, we determined that the probability of ever being, and what's the word again, redeemed, is so small that we're going to assume they're never going to be redeemed. So that's how firms do that. They get to a particular point and say they're never going to be redeemed. So for those, essentially we do the same journal entry as this guy right here, minus the cost of goods sold and inventory because nothing goes out. But it's essentially the same journal entry. Unearned revenue, at this point it's earned, because we've done all the work we had to do, we don't have to do anything else, and the remainder is 12,500, and we're going to, well, you call this sales revenue I guess, but we didn't actually sell anything. And just so we're clear, we'll look at the quick. Here's unearned revenue. We originally had 500,000. We reduced it by 25,000, and then we reduced it by 462,500. And then we had a balance of 12,500 that didn't get redeemed, and then we got rid of it right there. So when we get to the end, it's all done. Any questions about gift cards? What about coupons?
Coupon?
Do we do any accounting for coupons?
Only when they're redeemed.
Only when they're redeemed. It's basically just gonna reduce your sales revenue when they're redeemed. You don't really have to record anything else. The exception is something called a promotion, which we will do on the next page. But in general, coupons, you're not gonna do any recording for those.
What about like sale discount? Is that
What kind of sales discount?
like coupon? It's not. They don't lump them together.
So I guess what I'm saying is when you hand out a coupon to a customer, you don't do anything to record that
Okay.
in most cases. So you give them a coupon for 25% off on this date, you don't record anything when you do that. Now, if you give them a gift card that's worth $10, then you would record that, just like we just did. All right. And if they don't give you cash, then it's called a premium, and we'll do that on the next page. It is currently 8:45. Let's take about a 10-minute break.